Hi, I'm Julian, one of the financial planners here at Bigmore Associates, based in Walton-on-Thames in Surrey. If you have made any investments in the stock market or the bond market over the last 4 to 5 years, I think it's safe for me to make the assumption it's been a pretty turbulent time. Understandably, we had the worst pandemic in memory. We've had wars on the eastern parts of Europe, which have caused a lot of consternation. There's been a lot of aspects that have impacted. We've had inflation more recently come back significantly. Interest rates go up at a rate that we've never seen. The bond market, for example, which are loans to governments or to companies, in 2022 suffered its worst year in over 80 years. So yes, we understand if you're watching this going, yeah, my portfolio has really struggled. There's good reason for it. One of the mistakes, however, a lot of investors make is when they look back over a 2, 3 year, 4 year period and their portfolio investments haven't done well, they assume that it's just down to bad management, bad advice, and therefore good reason to get the heck out of there and move it somewhere else. Before you make that decision, because that could be the case, but what I would urge you to reflect on is another key point that is often missed when reviewing past performance. And that is simply when your investments have been made. Let me give you a good example. We have an equity portfolio for our clients that are happy to take full equity risk and give a lot of growth potential over the longer term. If a client invested in that strategy on the 1st of February 2020, and we then fast forwarded that return to the end of November 2023, their total return over that period would have been around 21%. So good news that it's positive, but it would have been 21%. Here's the key. If, however, another investor on the 1st of May 2020 invested in exactly the same strategy, their return, as at the end of November 2023, would have been 38%. That is nearly double what the other investor did by investing in February. Why? It's quite simple. The investor who invested in February was right at the top of the market before we had the COVID crash. The other investor who invested in the beginning of May was right at the bottom of the COVID crash just before the market started to rebound. So the point I'm making here is that you may look at your portfolio and go, oh, I've only got 21%, well, someone else has got 38%. Before making a judgment on the quality of how well it's been invested, it's really important to ask yourself the question going, am I comparing like for like? If you both invested it at the same time and the performance is radically different, well, then that's a fair point. Then perhaps your investment manager or financial advisor has got some more tricky questions to answer. But hopefully that helps you today to make that well-informed decision before making a knee-jerk reaction, even over a couple of years of underperformance. It's to understand that timing aspect. If you'd like to know a bit more about that or understand that in more detail, please get in touch. We're always happy to help. Thank you.